Volatility Index, one of the sentimental indicators in stock market. The most important term we hear during explosive moves in stock market. Let us discuss about this in this video. Hi viewers, Namaste. Welcome to the world of GetTrading. Markets, equity markets. To describe them simply, can we say that they are buy, hold and sell of shares? In the markets, if there is no fear, investors happily buy shares and build their portfolios. But if there is uncertainty or fear in market, the second thing institutions and smart pockets do is stop adding shares to their portfolio. The third thing they will do is sell the shares. But what is the first thing they do? Hedge their positions. So, when smart investors feel market's gonna fall, they hedge their positions in options market, and due to these like implementations by many investors, activity in options market will be more, particularly in index. This change in the main indices or particular index is monitored and shown to us in form of VIX. What is our Indian market main index? Nifty 50, right? So this VIX which is calculated from this Nifty is called Nifty VIX or India VIX, or simply we can call this as VIX. So in this video, if I say it as VIX, it can be also thought as Nifty VIX and India VIX. Okay, many people will say that VIX is same as implied volatility. Perfectly right. In the stock options or index options too, the expected volatility at each particular strike price is shown by this IV. With the same inputs but different formulas, this VIX tells us the overall index sentiments. Not of particular strike price but overall. Right, let us talk about the formula. We won't go in depth with this, but we will just touch the formula. Because at least we should know what factors it takes in formulas, right? The main inputs come from the order book itself, which means strike prices and ask and bid prices of both call option and put options. It uses the near expiry options contract and next expiry options contracts inputs. The expiry selection have some rules too, but let us not go in depth on this. Okay, the first step is to take the smallest difference of the premium in a particular strike price of both call and put. This strike price is known as forwarded index price. From there, it will take the OTM call option premium and OTM put option premium into consideration. For the forwarded index price strike, the average of both call and put premium is taken into consideration. Apart from this, time to expiry and rate of interest is also taken, and through complicated formulas, VIX is calculated and presented to us. The reason for me to explain this is to make you aware that VIX comes from these data itself, the data which we see regularly. Okay, the general misconception is that if there is rise in VIX, then index will fall. But if you understand the basic we saw before, it is clear that even the index may rise from the rise in VIX, right? Because we are thinking that if someone predicts that the index may fall, they hedge their positions using put options. But for example, if we know that markets will sharply rise, we can buy the OTM call options to get the rights of purchasing at discount, right? But one thing we have to accept is fear is more strong than hope or greed. So if VIX rises fast, it may be because of the fear only rather than greed. I mean to say, if it is hope or greed, it wouldn't have risen that much. Only if it is the fear factor, it rises at that pace. So that is why the VIX is also known as fear index. Okay, now back to the formula. As these premiums of calls and puts changes, this VIX also changes. That is, what I mean to say is, VIX changes with real time. We need to track the real time data of VIX too. Okay, before discussing how to track the VIX, let us know what this VIX metric says. That is, let us say that the VIX present value is 40. What does this mean? It is expected annualized volatility in Nifty for 30 days. Please understand it clearly. Annualized volatility of 40 means Nifty in 1 year may rise 40% or fall 40%. One more thing to keep in mind is this volatility validity is only for 30 days. That is, annualized volatility of 40% is only for 30 days. Please don't get confused. If in 1 year it is 40%, then in 1 month how much it will be? 40 divided by 12, right? No, trader. If you see the standard deviations concept and all clearly, for 1 month it will be 40 divided by square root of 12, that is 11.5. Not yet finished. This 11.5 is for 30 working days. So, for 1 calendar month, which is approximately 20 trading days, this VIX will be 11.5 divided by 1.5. So, 7.6%. So, VIX 40 says that the Nifty can move 7.6% in 1 calendar month. It can rise 7.6% or fall 7.6%. Of course, in this mathematical way, it has 68% chances. Okay, let us now see where to track this. We can easily track this from desktop applications like FireOne. Those who trade in this platform can directly track this in the same screen. You can also track this as a normal index opening in the chart too. Like if you want to see a Nifty chart or a Bank Nifty chart, similarly we can see this VIX chart. See, in the larger time frame, VIX normal range is also debatable. Some people say it as 50 to 30 and some people say it as 15 to 35. Or some people may also say it as 10 to 40. Let us suppose it as 15 to 35 is the normal range. So, whenever the VIX is coming out of the range, we must be cautious and alert. Okay, let us see the relation between VIX and Nifty. The other advantage of FIRES is, in the FIRES web, is this compare option. Let us select this option and add Nifty on the chart. To differentiate these two charts, we can change the settings. Like one we can keep the candle chart and one we can keep the bar chart, and also we can change the colors. Okay, by this compare option, we can see the correlation between any two scripts and analyze. Coming back to this VIX and Nifty, let us see in the larger time frame. In different times, just see how this VIX and Nifty are related. One important thing is, VIX is always better to see in the larger time frame, like weekly or at least daily. As said before, one thing to see the normal range is like 15 to 35 or something like that. One more way to track this is the 52-week high and low, that is 1 year's low and high, and treating it as the normal range. By this way, we can be more alert. Okay, now the main thing. Let us see the exact interpretation of VIX. If VIX is rising, it hints that there is huge activity in options market and that it may be because of hedging. And if in the same time there is no huge participation in the equity markets or it is in the range bound, it means that smart investors are not so certain about the markets, and because of no much buying, even a small trigger in selling will make the markets fall. These investors who are uncertain will also join the selling and will add more to the momentum in fall. When the fear ends and the hope starts, investors directly invest in the equity markets, leaving aside this options market. So, in the falling market, if VIX is falling, that means that there is a chance that market fall may stop in near future. So, to summarize, if markets are falling and VIX is rising, maximum chances are that the fall will continue. But when the markets are falling and VIX is also started falling, more chances are that the fall in markets will stop or pause a bit. So, uptrend or a sideways trend may follow. One more thing to keep in mind is, if the market is moving in a small range from many days, better to observe this VIX. If at that time VIX rises, you may be more sure that the range will break and that price rapidly moves either in upside or the downside. Okay, we heard that if VIX rises from a normal range, it is a problem. But what if it falls below the range? See, if suppose the markets are rising and the VIX is falling, what does it say? That there is no fear in anyone and all are bullish. The too much confidence is also not good for the markets. There is a theory in markets, too much bad news is a good news and too much good news is a bad news. So, if everyone is super confident and no one is concerned about hedging, there is more chance that the market may fall drastically. Observe the history once. For the final thing, you can use this information in options trading too, just like IV. If VIX is increasing, you can consider to be on the buy side. If VIX is decreasing, you can consider to be on the sell side of the options. As if VIX is rising, option prices will be traded on the premiums and so on. So, I request you all to please add this VIX to your analysis and get use of it. This video is all about the VIX. If you like this video, please like, share and comment on this video. Also, please subscribe to our channel and click on the bell icon. Also, please consider opening your account through us in the Fire Securities. Have a happy, safe and profitable trading. Jai Hind.